We talked about this in the video that came out last night, that now that the spotlight is off of Nvidia, you're going to see other areas of the markets rally. Small caps, cyclicals, second, third, and fourth tier AI stocks, and that is exactly what is happening today. So not to just, kind of pat myself on the back here, but here in this video, we're going to look at all of your news today, what I am personally doing in this market, and what you need to know if you are invested in this market right now. Now that the spotlight is off of Nvidia, the spotlight can go on to other areas. And that's important because that's exactly what is happening today. And it's even more inclusive than I was expecting. Now, I did say in that video, we would likely see small caps and other areas like mid caps also perform well, but wow. The Russell 2000 is up 2% today as the NASDAQ just went slightly red. The NASDAQ is down 0.08% today. The Russell's up 2%. This is the best case scenario. This actually shows a lot of market strength. Okay, because if Nvidia sold off, other Mag 7 names sold off, some of which are doing that today, and small cap sold off, like let's say small cap sold off more than Mag 7, that would have been a really bad sign. But I said leading up to Nvidia earnings, because I expected Nvidia would fall a little bit, okay, you were just priced for perfection. I said heading into that if everything sold off after Nvidia earnings, that is a major red flag, and I would be a lot more concerned. But if we rally after, the internals of our markets rally higher, you gotta be bullish on that. The Dow as well is up 1.2% today. The S&P, which, yes, has a very large weighting in big tech, is up 0.5%. But if you look at the RSP, what the RSP is doing today is up 1.34%. The RSP is the equal weight S&P. So taking all stocks, not using market caps, and just telling you what the average stock is doing, you're up 1.34% today in the S&P. Like, you are being dragged down by big tech. This is a fantastic sign for the bulls that are hoping for a year-end rally. I will tell you, though, again, as I said in the last video, as I've said before, there will be another growth scare. There will be a day of reckoning for markets. Probably not a crash. Probably not, 2022 again, right? But there will be a day in which Wall Street kind of looks around and says, that was a bad jobs report. That was a bad retail sales report. Maybe we do have a recession, right? There will be a growth scare again at some point, probably in the first or second quarter of 2025. You can almost see the writing on the wall for this. At least I can. I'm sure you guys can as well. It's kind of like Nvidia earnings heading into it. We all expected great things. We got great things, but was it as good as some expected? No. And that's kind of the same way the markets are set up. We're all expecting things to be okay. If things are not as good as we expect, then maybe there's a bit of a reset of expectations that needs to happen. Now, some of you guys are in the hard landing camp. Some of you guys are in the, soft landing camp. Doesn't matter. I think there will be a reset of more normalized expectations in Q1 or Q2 of 2025, which will lead to a correction in markets. Now, there's a lot of people also talking about right now this, by the election, which has been happening, but really by the Santa Claus rally as well, into year end, but sell the inauguration. Okay, a lot of people have talked about this, and that also is a risk factor that should not be overlooked right now. Okay, because we've priced in the good Trump policies, but there's also bad Trump policies as well. Good Trump policies include a lower corporate tax rate, more M&A activity, less regulation, right? Markets love less regulation. It's just you get things done faster, more growth can take place. It's good for business. Okay, regulations are never good for business unless they are drastically needed, like seatbelts in a car. Okay, that was good regulation. I don't know what else is good regulation. You can make an argument that most government facilities or programs have actually been bad. Do you know that the United States was ranked #1 in education in 1973 before the Department of Education was created? Now, a lot of people say, oh my gosh, getting rid of the Department of Education would be a terrible idea. We're ranked like 40th in the world for education now, and it all correlates down to that one thing. Now, I'm not here to say this is right or that is wrong. Just regulation's a really bad thing for corporate America, okay? For mergers, for buying companies. So to leave that all to the side, what are the bad policies? Bad policies, tariffs. Okay, that's #1 first and foremost, tariffs. We already kind of know what to expect because back in 2018, around October, we started to get into a trade war with China. There was bad rhetoric going back and forth. We're going to tariff this, they're going to tariff that, not allow this to be imported or that allowed to be exported. There's a lot of bad things that happened during that time. Markets fell 20% from October 3rd through December 24th. Christmas Eve. Yes, markets were open. Christmas Eve. And that's when you bottomed because both China and Trump kind of laid off some of the rhetoric as markets were basically collapsing worldwide. Okay. So if we get a repeat of that, you could see kind of a similar market reaction. That's a risk factor. Now, I think the markets will dictate what policies are ultimately enacted. So if we do go through a crash or a correction or something, then I think you wouldn't see that specific tariff be enacted. And I'm sure there's going to be a deal made, art of the deal, right? There's clearly going to be a deal made. But that's a risk factor, especially heading into 2025. So I just want to kind of tame expectations here. Stocks can do well for a while now. Couple of weeks. I think some mid caps, cyclicals, perhaps small caps that have been unjustifiably punished because Nvidia and other AI names have taken the spotlight can really rebound here. And I think that's where the opportunity is, but also don't be blind to what's coming as well. Like there will be a correction or crash at some point in early 2025. If not to, around late December, it wouldn't surprise me if we kind of get ahead of the inauguration, sell the inauguration kind of mentality. As that's what Adam Parker said on the Compound and Friends podcast, that maybe it happens a few weeks ahead of the inauguration, maybe the start of the year. Who knows? Don't be too leveraged. Have cash available. And be ready to buy when that opportunity does come along. With that said, though, there is also good news today that is driving markets higher. Not just Nvidia kind of taking the back burner and letting other stocks work. There is actually initial jobless claims that rose 213,000 last week. The estimate was 220,000. The previous week was 219,000. This is the lowest week since May 24th of 2024. So this is really helping to instill confidence of the soft landing. So this mixed with Nvidia kind of taking the back burner is helping small caps, the Dow, recover quite a bit today. You also had, for the first time in a while, existing home sales that beat expectations. Existing home sales came in at 3.96 million. The expectation was 3.95 million, and last month's number was 3.83 million. So if you start to get more homes that are being sold, that could be good for housing inflationary pressures. Also, I talked about this about a month or two ago, just thinking about upside catalyst for 2025. One of which is if homes do start to sell more. Okay, because most families' largest chunk of equity is not in their stock portfolios, it's in their homes, especially over the last couple of years. So if people can start to capitalize on that and let's say sell their $400,000 home they bought for $200,000 after, let's say, $50,000 of commissions and maybe slight repairs and concessions at selling, they're going to walk away in their bank account with $150,000, even if they use $50,000 or $100,000 to put down on a new house, because a lot of people like to put more down on a house. I don't think that's a great idea. You want to leverage real estate as much as possible because it's such a safe asset. I own rental properties, really a topic for a new video. but they're still going to walk away with like $50,000 to $100,000 in their bank account. They're going to go on vacation. They're going to go buy this. They're going to go do that. People like to spend. That is the U.S. consumer. So if you do see more homes start to be sold, even if you say 2 million homes could be sold, and that could unlock, let's say 2 million homes next year. Like that's really low. We should probably go with like 3 million, because 2 million's maybe a little bit too low. And say on average, each home seller walks away with $100,000. That's $300 billion of extra money that people just unlocked from their homes. I mean, that's pretty good. That's like a month or two of retail sales data for the US last I checked. Like, that's a substantial difference. And although I think we are kind of priced for perfection as far as the economy is concerned, I think there's kind of a similar risk again to what happened with Nvidia happening with the broader economy. Everyone's in the soft landing camp. Even if that happens, I think there will be waves to it, right? There'll be really good months, really not great months, and really good months, and not so great months. This is an definitive upside catalyst that I can see if real estate can start moving again. Okay. And I haven't heard anyone say this or talk about this, and it does have a lot to do with rates. So hopefully inflation does come down more than expected in 2025. That's my prediction. So it wouldn't surprise me if you do see people able to sell their homes as an upside catalyst for markets. Ryan Dietrich on X says saying that small caps would do better than large cap tech wasn't a very popular call, but we've been sticking to it. Most might not realize that over the past year, small caps have done better than the QQQ. We expect this to continue. As of Q3 2024, 90-day plus delinquencies rose for all major categories. Credit card rates were highest at 11.13%, followed by other consumer finance and retail loans and auto. According to Bloomberg Intelligence, there is a rise of delinquencies pretty much across the board. Now, some are not as high as like 2020, like auto loans here. They're getting up there, but not quite as high. Other loans are substantially higher than 2020, as well as credit cards. They are quite a bit higher as well. This is definitely something we want to watch closely, and I think is really, again, a testament to what I've said here in this video, that there is risks that markets really are not focusing on. And for anyone that loves crypto, Trump's crypto council to set up new US Bitcoin strategic reserve, as per Reuters. And it's also being reported that US bankruptcies in 2024 have officially surpassed 2020 pandemic levels, with 570 large US companies that have declared bankruptcy year to date, the most in 14 years. And during a Bloomberg opinion article, Jesse Felder here is reporting that Buffett's $325 billion of cash hoard, or cash on hand, is an early warning signal. Again, this is probably for the same reasons that I'm talking about. I don't think Buffett expects a depression or some kind of severe recession, but I think any logical person can say, if we're priced for perfection, if everyone's expecting a soft landing, the risk is that we don't get the soft landing versus that actually does happen. Because if we do get a soft landing, great, we've been expecting it. If we don't get a soft landing, then boy, do we have a major problem. Bar chart on X posted this. Someone just paid $6.2 million for a banana duct taped to a wall. Yes, this is actually true. Bar chart says, okay, Jerome Powell, time to raise rates again. And I mean, yeah, if that's what's going on, it probably is. Oppenheimer, in a note out to customers today of their service, says that they looked at the last 11 years in which the S&P 500 jumped more than 20% over the first 217 trading days. In those years, the smallest additional gain from that point through the end of the year was 0.5%. That means that if history repeats itself, the S&P 500 should end 2024 above 6,000. What's more, Oppenheimer found that the gain matched the median advance in those 11 years would push the S&P 500 to finish higher than 6,200. UBS says expect the roaring 20s to continue and the S&P 500 to potentially hit 7,000 next year. And again, another testament to everyone being maybe a little too optimistic. November, Kansas City Fed Manufacturing Index up to -2 versus -5% as per the estimate, and -4 prior. New orders deteriorated to -9 from -5 prior, with an average work week that fell to -9. -7 prior. Shipments fell to 0, +7 prior, and employment improved to +1, -2 prior. So this is actually pretty bad data with new orders that literally deteriorated. But this is one of those higher frequency data points. The markets don't pay too much attention to the actual internals. They just look at the headline number and they say, oh, things are great, things are not great. But this is really being improved via the employment and really just optimism overall for manufacturing. And apparently the situation's getting pretty bad over in Canada. Canada to issue a one-time cash transfer of $250 to individuals earning less than $150,000 per year. They're actually sending out stimulus checks. I don't know, maybe Powell does need to raise rates because, wow. Or maybe what's happening in Canada is gonna happen over here next. I don't know, but once you start sending out stimulus checks and there's that kind of narrative, yeah, and inflation could be a problem again. Although that's Canada, this is the United States, we're different. I just don't see that as a great sign. It's Roberts posts on X, the six week change in liquidity has turned sharply lower, which explains the recent market struggles. However, Bitcoin, which tracks liquidity closely as a risk asset, is a risk of a correction. CNN Fear and Greed Index today is coming in at 59, which is now in greed territory. Yesterday, you were exactly neutral at 50. Market momentum is greed, stock price strength is fear, stock price breadth, extreme fear, put and call options, extreme greed, market volatility neutral, safe haven demand in greed, and junk bond demand in extreme greed. As well as that, the percent of stocks currently trading above their 50-day moving average is up 8% today. You have 4.36% of all stocks breaking above their 50-day moving average, and again, a testament to the RSP that is absolutely soaring today, the equal weight S&P. This is a good sign. With that said, do not grow complacent. There will be issues along the lines over the next couple of months, and you want to prepare for that as soon as possible while not missing the upside that is currently here. I like to say, stick with what's working until it stops working. And right now, markets want to go higher, small caps, mid caps, cyclicals, AI names, second, third, fourth tier AI names. These are data centers. These are software companies, right? That's what is going to work from now into year end until we get this correction, I think, in the beginning part of 2025. And that's how I'm positioning. I'm staying in markets. I'm staying in these positions. I'm actually adding to positions. I added Elastic NV today before earnings because that is what I would say a second or third tier AI stock, right? I added a little bit of Square today, right? I'm doing some buying here selectively. I'm not buying the indexes. I'm not buying the hot Mag 7 names. I don't like the risk to reward there. And if you are trying to make the most amount of money, I think this video really applies to you. So with that said, let me know what you are doing with your portfolio down below in the comment section. Have a fantastic rest of your day. Stay safe out there, and I will see you in the next one.